The October 10, 11, 2025 crypto flash crash and exchange mismatches estimated liquidation $19+ billion, 24-hour market-wide. Affected traders over 1.6 million primary. Catalyst geopolitical macro shock, U.S. tariff threats against China. Amplifying factor systemic vulnerabilities on major exchanges, particularly with certain collateral assets. Executive summary: the largest crypto liquidation event in history. The cryptocurrency market experienced its most violent deleveraging event on record over October 10, 11, 2025, resulting in the forced closure of over $19 billion in leveraged positions and impacting more than 1.6 million traders. While the initial shock was external, a sharp sell-off triggered by announcement of 100% tariff threat on Chinese imports, the scale of the disaster was overwhelmingly amplified by systemic vulnerabilities on several major centralized exchanges, CEXs, and decentralized finance, DeFi platforms. The critical failure point centered on the depegging and valuation collapse of certain volatile collateral assets on Binance's margin and futures platforms, primarily Ethena's USDe, wrapped beacon ETH, wBETH, and Binance's BNSOL. The ensuing chaos led to a reflexive death spiral of cascading liquidations, fueling widespread allegations of technical failure, flawed system design, and even a targeted exploit against the exchange. Binance subsequently acknowledged the technical failures and committed to a massive compensation plan for affected users. A timeline of the market-wide cascade. The events unfolded rapidly in a tight window, demonstrating the fragility of an over-leveraged and thinly liquid market. Time, UTC, event details, and impact OCT. 10 in 2050 macro shock catalyst. A post from President Trump threatens to press wBETH frame 100% tariffs on China. Traditional markets and global risk assets begin a sharp sell-off. 11 onward normalization and recriminations markets stabilize and begin a partial recovery. Exchanges assess damage and the community erupts with postmortems and allegations. Binance announces a compensation plan. Biseku. The core technical failure: collateral depegging. The unprecedented scale of the liquidation stemmed from a critical platform-specific risk management flaw at major exchanges, most prominently reported on Binance. Flawed collateral pricing logic. The major technical issue was the reliance on internal spot market prices for highly volatile, complex assets used as collateral, specifically USDe, wBETH, and BNSOL, in cross-margin products. Internal Oracle loop. Instead of referencing robust external Oracle feeds, which often use a composite index or the asset's underlying redemption value, Binance's system reportedly relied on its own thin spot order books. The vicious cycle. When the macro sell-off began, the spot market for these niche assets became illiquid. A small amount of panic selling or forced closing of positions could send their price plunging. Since the collateral value was derived from this plunging internal price, it triggered more liquidations, which, in turn, dumped more of the same assets back onto the order book, creating a reflexive death spiral of depegging and liquidation. Exaggerated losses. This mechanism resulted in users being liquidated based on collateral prices, $0 at $65 for USD, that were dramatically lower than their actual off-exchange value, which remained near wBETH $1 on fundamental redemption platforms. The vulnerable assets. The three primary assets involved in the depegging were USD, Ethena's synthetic dollar, designed to maintain a wBETH $1 peg via a delta-neutral hedging strategy. While Ethena's core redemption mechanism reportedly remained functional, the spot market price on Binance collapsed due to the liquidation fire sale. wBETH, wrapped beacon ETH, Binance's liquid staking derivative for staked Ethereum. Its value should closely track ETH BNSOL, Binance-pegged Solana liquid staking token. Its value should closely track Solana, SOL. The rapid, deep depegging of these assets gutted the margin balances of countless users, including those who believed their positions were well hedged by a stable or pegged collateral. 3. The people's allegations, technical failure versus targeted exploit. The scale and nature of the crash, particularly the rapid collapse of collateral value, ignited a fierce debate in the crypto community, leading to three main allegations. Allegation 1, the targeted exploit theory, the Luna 2 claim. A highly publicized theory, framed by analysts like Dr. Martin Heesbuck and Colin Wu, alleged the crash was a deliberate, targeted attack to exploit a pre-existing vulnerability in Binance's unified account margin system. The flaw as a target. Critics claimed the system's reliance on internal volatile spot prices for liquidation data was a known design gap that created an obvious target. Suspicious timing. The attack was allegedly timed precisely in an wBETH 8-day window after Binance announced an upcoming fix to its Oracle pricing logic, October 6. But before the fix was fully implemented, October 14, this window gave sophisticated actors time to prepare and execute. Collateral manipulation. The core claim is that an attacker or a group used massive short positions on BTC-ETH as cover, while surgically manipulating the thin order books of the collateral assets, USDe, wBETH, BNSOL, to trigger a maximum yield liquidation cascade on over-leveraged accounts. Allegation 2. Insider trading and market manipulation reports circulated on social media of a large volume trader, or whale, who reportedly opened a substantial approx $400 million short position in BTC and Ethena in the days leading up to the crash, closing it for an estimated approx $190 and $200 million profit right after the bottom. The coincidence claim, the fact that this short position was allegedly doubled just wBETH $30 minutes before the Trump tariff announcement was made public, fueled widespread speculation of insider knowledge or a perfectly executed information arbitrage trade. Systemic purge. Other longtime market commentators like Arthur Hayes speculated that large centralized exchanges' auto-liquidation of collateral tied to cross-margin positions was a key driver, describing the event as a necessary purge of excessive leverage. Allegation 3. Exchange systemic instability. Many smaller traders who were liquidated reported critical platform-related issues that prevented them from mitigating their losses. Lag and latency. Numerous users complained that the exchange's API and trading engine suffered from latency issues and slow order execution, preventing them from adding margin, closing positions, or placing bids to counteract the crash. API overload. The immense volume and number of liquidations were so large that some systems reportedly seized up, leaving users at the mercy of the automated liquidation engine with no human or technical recourse. Unjust liquidation. The most common and painful user allegation was being liquidated unjustly because their collateral was valued at a fraction of its true price by the internal Oracle system. Accounts with substantial real assets were wiped out in minutes due to a technical miscalculation. Fee. The exchange response and compensation. In the wake of the crisis, Binance's leadership, including CEO Richard Teng and co-founder Yi He, apologized publicly, accepting responsibility for the platform-specific issues. Compensation pledge. Binance committed to compensating all futures, margin, and loan users whose positions were liquidated due to the depeg of USDe, BNSOL, and wBETH between $wBETH $21.36 and wBETH $22.16 UTC on October 10th. Estimated payout. The total compensation is estimated to be over wBETH $283 million, covering the difference between the user's liquidation price and the asset's post-crash recovery price, plus any liquidation fees. No clawbacks. Notably, the exchange explicitly stated that users who profited by buying the depegged assets at low prices would wBETH not have their gains reversed. Policy change. Binance has committed to adjusting the pricing logic for wrapped and staked assets to rely on more robust external reference feeds rather than its internal spot market to prevent a recurrence of the Oracle loop failure. While other platforms like the DEX Hyperliquid also reported massive liquidations, wBETH $10, $31 billion, and some smaller platforms promised compensation, Binance's incident involving major collateral assets made its failure the structural epicenter of the approx $19 billion market wipeout. The crisis exposed a critical need for standardized, robust risk management and oracle systems across the high-leverage crypto derivatives industry.